Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more content like this, please visit adisa.org and check out the resource library. Today is a podcast-only edition of Focus on Alts, and I'm your host, Greg Mausz. I'm joined by Jason Plucinak, who is a partner and the VP of Corporate Finance at Legion Capital. Jason, thank you for joining us here today.
Happy to be here.
So today we talked about a topic that's very interesting and it's complex, and it's really how alternative investments are created. And it's really understanding the product and also the legal structures. And there's just a lot of options out there. So if you can just kind of intro this into us with all these wide options of the product and legal structures, can you just kind of describe the difference between those two concepts to begin with?
Sure. First off, product and legal structure are not necessarily the same thing. I think that's important to know. With legal structure, that really determines how the offering documents are created and ultimately dictate what rules and standards the product must adhere to from a regulatory standpoint. Examples of legal structures include Regulation D, Regulation A, S1 and S3 registrations, Delaware statutory trusts, qualified opportunity zones, Form N2s under 1940 Investment Act, and of course, real estate investment trusts, or REITs as we call them. There's a lot of legal structures and a lot of options. When it comes to product structure, on the other hand, that refers more to the product itself and the features and benefits that encompasses. So examples of product structure would be a note, debenture, bond, preferred stock or common stock. Other product structures would be closed-end funds, interval funds, limited partnership interests, BDCs, business development companies. So there's a lot of options when it comes to both legal and product structures.
You're right. And, in the fundamental of alts discussion that we have at the ADISA conferences, we throw all these up there on the screen because they all have different purposes and utilities that both empower capital formation for the sponsor, but also offer unique benefits for the investors. So let's break that down further. Can you go through more details on the legal structures?
Yeah. For timing's sake, we won't go through all of them, of course.
That's fair. Thank you.
But let's talk about some of the more common ones. Regulation D, Reg Ds, for example, also referred to as private placements. Those are private investment offerings, meaning that no public entity like the Securities and Exchange Commission, or SEC, reviews those offering documents. Now, that certainly doesn't mean Reg Ds are a free-for-all. Reg D offering docs are generally created with experienced securities attorneys, tax advisors, and of course are written in ways to adhere to best practices within the industry. It simply allows the security issuer to streamline their process and get to market more quickly. There's also different variations on Reg Ds. The two most common we see in the marketplace are 506B and 506C. Neither of them have a limit on how much capital can be raised, but there are a few notable differences. First off, 506B does allow up to 35 non-accredited investors into the offering, but there are very strict rules against general solicitation and marketing efforts, things of that nature.
But from all intents and purposes, do you ever really see people using that 35 non-accredited investor, sleeve?
In practicality, no.
Yeah, that's what I've seen too.
It's there, but if you're doing all of the work to create an investment product and bring it to the broker-dealer and RIA community, and you're choosing Reg D as the legal structure, you're looking for accredited investors.
Right.
And that's why a lot of folks currently are leaning more towards the 506C, because although it only allows accrediteds, it is now allowing more options with general solicitation and marketing efforts in various forms across the spectrum. As far as other legal requirements with Reg D, sponsors are just required to file a notice filing with each state they intend to raise capital in. So there's no approvals required. The sponsor simply issues a Reg D exemption notice filing state by state.
Which the other side of that are registered offerings that have to blue sky in every state, which is a complicated, time-consuming, and costly process. So that absolutely.
Now there's a legal structure called Regulation A that's gained a lot of popularity over the last number of years. Reg A's are generally known as small or medium-sized offerings that have that transparency element to them and don't have to go through the blue sky state-by-state registrations like you just mentioned. That's because Reg A sponsors must file their offering documents with the SEC, undergo a review and comment period, have their offering qualified by the commission before they can begin raising capital. That automatically clears them in all 50 states when it comes to blue sky. So companies that issue securities via Reg A also are required to file audited financial statements with the SEC, and that brings in the transparency factor I mentioned. There are also two tiers of Reg A. Tier 1, companies using that registration that qualification can raise up to $20 million a year. And Tier 2, much more common in the BD and RRA space, often referred to as Reg A+. Those companies can raise $75 million a year.
Okay. That makes sense. And I'm glad that we touched on Reg A. What about other registration types?
Well, S1 and S3 registrations are very common in the space for what I would consider larger issuers. S1 and S3s are used for companies that are generally already publicly traded or might be looking to go public in the near future. Those require a pretty rigorous registration process with the SEC. Full background on the company, executives, detailed use of proceeds information, plan of distribution, stock ownership details, et cetera, et cetera, et cetera. With an S1 or S3, quarterly and annual audited financials are also required and must be kept up to date in order for the company to continue raising capital in that offering.
Makes sense. Okay, so the sponsor picks the legal structure. That's basically puts them on a road or puts them on a path. And they start to head down that road. But I'm envisioning a road with guardrails on either side, and that the issuer then has room or more leeway on the product structure and the features and the benefits that they design. Am I on the right path there?
Absolutely. Once a sponsor commits to that legal structure, their guidelines are established, and they're able to create the investment product with the best structure and features and benefits that meet their goals. There's a lot of interchangeability. We've listed a lot of legal and product structures. But to give you an example, an N2 registration under the 1940 Investment Act could structure their product as a closed-end fund. They could do an interval fund, or they could do a BDC, all under the N2. So there's a lot of interchangeability when it comes to product.
That makes sense. What are some other examples and details of different product structures?
Yeah, when we look at Reg Ds, we see a lot of simple funds. Funds, of course, are structures where investment dollars are pooled together and deployed into the designated strategy. Structure and details vary fund to fund, but often consist of a target return, a preferred return, and an anticipated hold period. Target return is just as it sounds. It's the annual percentage return that the investment managers are targeting. It's, of course, not guaranteed, but more of a guideline based on realistic expectations. Preferred return is generally a percentage rate lower than the target, but it's committed to the investors prior to the manager sharing an additional profit. It's also referred to as a hurdle rate. Mm-hmm. The preferred return is often referred to as a hurdle rate. Anticipated hold, again, self-explanatory, expected time period for investors to get their money back. But note that's an estimate. Some funds can return investment dollars earlier, some later. And there's also fees to consider when we're looking at funds within Reg D structures. How are the varying parties going to be compensated in the endeavor, from the fund manager to the managing broker dealer to the selling financial rep?
Sure.
An example, if we move to a Reg A, non-traded bonds are a very common product structure with Reg A's. Those, of course, differ from funds in a few primary ways. One, a bond is going to be a fixed instrument. The hold period and the interest rate are fixed obligations. So an example of that would be a 3-year bond paying a 7% interest rate. Those are company obligations, those terms, the 3 years, the 7%, and that company is obligated to adhere to those. That's actually enforced by other legal docs, things like indenture agreement, security and pledge agreement, more legal jargon we won't dive deep into today, but there's other product structure details with the non-traded bonds out there, early redemption provisions, transferability, and very importantly for the investor, where they fall on the capital stack or seniority position.
And I'm actually glad that you brought up Reg A bonds, because lots of people think Reg A equity, but you can also put that bond structure under the Reg A banner. Absolutely. And if you think about it, Reg A they're qualified with the SEC. So the issuing company is reporting to the SEC. So they're often C corps or operating companies. So a bond structure makes sense in a lot of cases. If we go one step above that for the bigger offerings and the more scrutinized reporting, that would be the S1 and S3 registrations that we talked about. A good product example in that realm would be preferred stock. We see preferred stock quite often, and those are typically chosen by S1 and S3 registrants because of the public company nature. Raising preferred stock is raising preferred equity, and an equity component on a public company's balance sheet is critical. A lot of different product options and structures available there. Convertibility, can that preferred be converted into common? If so, what ratio, when, etc. Liquidity is another product structure item. Can investors redeem their preferred stock after they purchase it? If so, when? Will it be redeemed in cash, or will it be redeemed in the company's stock, common stock? Also, redemption fees. We often see preferred stock issuers design a declining redemption fee schedule, right,
which, of course, incentivizes longer-term holds, but doesn't necessarily lock the investor in front and center.
Right, which when you look at alternative investments from the investor perspective, it's good to have some products that are structured for a longer term hold and some that offer, more immediate or near-term liquidity if needed, right? Oftentimes, alternative investments are made for the overall portfolio and what it can do in reducing volatility, but sometimes liquidity is needed. So you've been walking us through, there's a lot of variations with legal and product structures in the alternative space. So how does a company come together with all these things, form an offering that they then use to raise capital from broker-dealers and RIAs?
Well, that's the million-dollar question, Greg. Ultimately, there are endless variations, like you said. At the end of the day, the issuing companies, they've got to find a middle ground, really, between what's best for them to raise capital and execute on their investment strategy, whatever that might be. And, of course, then what makes sense for the broker-dealers and RIAs from both the sales and risk perspective. The details in all of this aren't necessarily scrutinized when everything is going great, but the structural components and the fine print make all the difference when things don't go as planned. So, broker-dealers and RIAs have a big job when it comes to evaluating all of this and looking at the structures and products out there. I firmly believe that these firms are putting their firm on the line every time they form a new relationship with an alternative sponsor. So ultimately, the most successful relationships really come down to people wanting to do business together and working to design products that are both saleable, to drive revenue, but also mitigate risk to the furthest extent possible.
And I think you just keyed on to something there. You use the term working together. And I think that's what needs to happen. The product sponsors would be wise to consider what the broker-dealers, RIAs, and their financial advisors want today. What are they looking for their investors? Just bringing product to market without that frontline research, without that investor-centric focus can end up being very frustrating for the sponsors who aren't able then to attract the capital that they were looking for their investment thesis. So it needs to be a very collaborative effort, and the sponsors need to have the right type of managers, distribution partners, so that they can get this proper business intel in designing these products.
Absolutely. I think you made a great point, and it's that you should begin with the end in mind. And the end is the investor.
Right.
So, let's design, structure, and create investment products in collaboration with our distribution partners, our broker-dealers and RIAs, with the end investor in mind, and that can help create the best products and bring the best results at the end of the day.
Jason, really appreciate you walking us through this complex, complicated, but you did a fantastic job of breaking down the different structures and angles in creating alternative investments. Really appreciate your time.
Thanks so much, Greg.
And thank y'all for listening to another edition of Focus on Alternatives. Again, for more information like this, please visit adisa.org. Thank you.